Good morning, ladies and gentlemen, and the board of Coca-Cola Amatil Limited. This morning, my colleagues James, Niv, and I will be giving you a short presentation on Coca-Cola Amatil, its operations and financial statements, consolidation reporting, and subsidiary reporting. To start off the presentation, I'm going to hand over to my colleague James to talk about operations and financial reporting.
Thanks, Braidan. Coca-Cola Amatil is a major manufacturer, seller and distributor of many various products, such as soft drinks like Coke and Sprite, water like Mount Franklin, sports drinks like Powerade, energy drinks such as Mother, and various other fruit drinks, flavoured milks and coffees. They also have a packaged fruit and vegetable line under the brand SPC, which is very, very successful. Coca-Cola Australia also holds the licenses to produce, sell and distribute to countries Australia, New Zealand, Fiji, Indonesia and Papua New Guinea. A benchmark of CCA success is its profit after tax attributable to members. In the 2010 financial year, that figure was $497.3 million, which is an increase from last year's $449 million figure. All figures are sourced directly from the company's income statement. Mr. Terry Davis is the CEO, Group Managing Director, Executive Director, and also has been a board member since November 2001. His base remuneration package is about $2.142 million, but when you include share-based payments, it jumps right up to $7.67 million. Coca-Cola Amatil is audited by Ernst & Young, and they are a very well recognized Big Four accounting firm. They believe that Coca-Cola Amatil reports true and fair statements and they comply with the International Financial Reporting Standards. The auditor's remuneration was $2.817 million in 2007. I will now pass on to Niv, who will continue.
Thank you, James. I'll be talking about the subsidiaries of CCA, the jointly controlled entities, operations and assets. CCA has 100% holding of 57 subsidiaries in the year ended of 2010. The controlled entities all range from drink products to food products, which make up the CCA group. According to the 2010 financial reports, there are no shares that are under 50%. However, there is minority interest within the group, such as Neverfell Spring Water Ltd holds 40.7% of the shareholding in Neverfell Bottled Water. CCA, it is also a multinational company, so it has subsidiaries all around the world, in places such as New Zealand, Cyprus, Netherlands, Papua New Guinea, Germany, and Spain, which is there to expand their market share. As you can see, these are the list of subsidiaries that they own, and there are 100% shareholding in 2010 and 2009. This is a joint venture, so CCA has 50% interest in joint venture entities, Pacific Beverage Pty Ltd, as you can see. Sam Miller holds the remaining 50% shared interest. Both companies jointly control Pacific Beverages Ltd. The investment in the joint ventures is $74.4 million for the year ended 2010. CCA has 57 other subsidiaries, all of which CCA holds 100% of the issued share capital. The company manufactures bottles and distributions on alcoholic beverages, which is a joint controlling operation. CCA also has a bottlers agreement in place and is a representation of a relationship between CCA and the Coca-Cola company, which is an international company. CCA's majority, which is CCA's majority stakeholder as well, which is also seen as a JCO, joint controlling operation. Aside from the jointly controlled operations, interest in Pacific Beverage Pty Ltd, CCA has not disclosed any other jointly controlled operations or assets. The company, through indirect interest in its subsidiaries, may have further JCOs, however, it is not required to disclose them in the financial reports. Now, we'll give it to Braidan.
Thanks, Niv. It's now my turn to talk about consolidated goodwill, tax consolidation, segment disclosures, and accounting for consolidated entities. To start, For the 2010 financial year, the value of consolidated goodwill was $387.5 million. Goodwill in the 2009 financial year was recorded in the financial statements at $388.2 million. During the 2010 financial year, goodwill was not subject to any impairment expenses, however, was decreased as a result of foreign currency movements. For the purpose of impairment testing, CCA has defined cash-generating units as its segmented businesses, being the markets of Australia, New Zealand, Fiji, Indonesia, and Papua New Guinea. On to tax consolidation. The company and its wholly owned Australian resident subsidiaries have formed a tax consolidated group. CCA is the head entity of the tax consolidated group. The entities within the group have entered a tax funding agreement whereby each subsidiary will compensate CCA for the amount of tax payable that would be calculated as if the subsidiary was the tax-paying entity. CCA and the subsidiaries within the tax consolidation group continue to account for their own current and deferred tax amounts. The amounts are measured as if each entity in the tax group continues to be a standalone taxpayer in its own right. The current tax balances are then transferred to the head entity CCA through intercompany balances. As discussed before, the Coca-Cola CCA is also required to disclose its segmented businesses. The group operates in 4 reportable segments, based on a combination of factors including geographical, products and services. The disclosure comprises of investments in joint venture entities, investments in bottlers agreements, property, plant, equipment and intangible assets. These segments need to be disclosed under the Australian accounting standards. Finance income, costs and income tax are managed on a group basis and are not reported internally at a segment level. Cash equivalents, debt-related derivatives, assets, liabilities, loans and borrowings are not included as part of segment assets and liabilities as they are also managed on a group basis. CCA uses the equity method to account for the investment in the joint venture it has Pacific Beverages Proprietary Limited. However, it is carried at cost by the parent entity. Business combinations within the company are accounted for under the acquisition method, and the cost of acquisition is measured with the aggregate consideration transferred at acquisition date fair value with the amount of any non-controlling interest in the acquirer. With the investments that are made in the bottlers' agreements, all investments are carried at cost. Because the investments in the bottlers' agreements are considered to have an indefinite life, they are not amortised but are tested annually for impairment in the carrying amount. The liability method is used when referring to a deferred tax and is recognised with deferred tax assets and liabilities being used to account for temporary differences. Goodwill is not amortised by CCA, but is tested annually or more frequently for impairment in the carrying amount. Any goodwill arising on the acquisition of subsidiaries is treated as an asset of the subsidiary. Share capital is recognised at fair value of issued and paid up capital, less transaction costs and net of tax. Finally, I'd like to summarise the subsidiaries position of CCA. As you can see, Coca-Cola Amatil Limited is the parent entity. It has 16 directly controlled entities, of which it owns 100% of the capital on issue. Each of those companies has got several subsidiaries of its own, which Coca-Cola, through indirect interest, receives the ultimate benefit. Many of those companies further have subsidiaries of their own. However, to disclose such in this presentation would have become ridiculously extensive. This concludes our presentation for today. I'd like to thank you for your time and my colleagues. Cheers.